Good day everybody, I trust that you are well. The aim of this video is to explain to you in layman's terms why Britannic Opportunities Ltd is worth considering. Let me just start off by positioning Britannic Opportunities Ltd for you. It is one of 7 Guernsey incorporated Bermuda listed companies that has been set up by Investec since 2002. It is an existing company with existing shareholders. It was established on the 7th of July 2014, and it was for a duration of 5 years. That's why it's maturing now on the 7th of July 2019, and it was linked to the FTSE 100 index. Currently the FTSE 100 index is only up 7.69%, but the shareholders of Britannic is going to receive 38% in pounds. It's quite a remarkable achievement. That's more than 5 times more than what the market has delivered. Usually if the market yields 7.69, you only get 7.69. In this case, the clients are going to get 38%, or the investors or the shareholders, should I rather say. But this is the historic performance. Let's go and have a look at what can new investors expect to receive, since the company has now opened up for new investors to come in, and it will be closing on the 5th of July, which is early next month. So let's start off with what we know. We know that listed shares is the best asset class that you can invest in. Why do I say that? If you have a look at the asset classes that's available for you to invest in offshore, you can invest in cash, which yields about 0.5% per annum. You can invest in bonds, which yields about between 3 and 4% per annum. You can invest in government bonds, and you can invest in corporate bonds. You can invest in listed property, and you can invest in listed shares. So from a return perspective, it's by far the asset class that gives you the best opportunity to beat inflation, or the best probability to beat inflation, should I rather say. So history has proven that equity returns are superior to bond and cash returns. Why do I say that? This was a study that was done by Credit Suisse in 2016, and they analyzed the data of 116 years since 1900 to 2016. And what they found is that equities grew by a factor of 300 compared to 8 for bonds and 2.7 for cash. So that equates to a real return, which means a net of inflation return of 5% per annum, that equities grew by over the last 116 years. What else do we know? We know that you can't time markets, because if you miss a few of the best days, it will destroy your long-term returns. This is a study that was done by JP Morgan. They analyzed a period from 1995 to 2014, and it was based on the S&P 500, and they used an investment amount of $10,000. So if you invested $10,000 on the 3rd of January 1995 and you were fully invested for this 20-year period, you would have received $65,453 back, which equates to a 9.85% return per annum. However, if you only miss 10 of the best trading days, and just keep in mind that there's 261 trading days in a year, so times 20 years gives you 5,220 trading days. So if you just miss the best 10 out of the 5,220 days, your return comes down from 9.85 to 6.1%. And just note that the $32,000 that you would have received at the end of the 20-year term is less than half than what you would have received at a 9.85% compounded return. And it gets even worse. If you miss the best 20 days, that falls further to 3.62% or to $20,000. And if you miss the best 30 days, you basically only get $3,446 back over a 20-year period. So this just illustrates that we can't time markets, and we have to be fully invested during cycles. This was also research that was done by PSG, and it was done on the JSE All Share and on the MSCI All Country. The MSCI All Country is 23 developed markets and 24 emerging markets. Same thing, based on an investment amount of 10,000 Rand. If you missed the best 10 days, what impact would it have had from being fully invested to missing the best 10 days, missing the best 20 days, missing the best 30 days, 40 days, the best 50 days. So you can clearly see the impact of missing a few of the best days destroys your long-term returns. If we move on, just to position where does Britannic fit into your wealth strategies, Britannic Opportunities Ltd is an offshore listed share, in other words, foreign equity. So if you have a look at it from on this graph, you will see that we basically divided into three strategies: an income provision strategy, a wealth preservation strategy, and a wealth creation strategy. So foreign equity falls into the wealth creation strategy, which basically means that you should only invest money that you do not need for the next 7+ years in foreign equity. You can't invest money that you anticipate you're going to need in the next year or two in foreign equity, as there can be currency fluctuations, and equity as an asset class can be quite volatile, so the investment can be down. If we have a look at how do we invest in offshore equity and offshore listed shares, we can do it by way of a unit trust investment. There's currently 230,000 plus unit trust funds that you can invest in offshore, or you can invest in direct listed shares. There's more than 50,000 companies listed offshore that you can choose from, or you can invest via an exchange traded fund. There's currently 2,024 exchange traded funds offshore. Just to explain what an exchange traded fund is, we're going to look at the top 40, which is the most common exchange traded fund in South Africa, which most people are familiar with. So we'll go into a little bit more detail on that, just to show exactly how does an index work. And you can also invest in foreign equity by way of a structured product. So Britannic Opportunities Ltd is a structured product which underlying uses an ETF for your potential upside, and we'll go into more detail to unpack that. So for the purposes of this discussion, we're going to look at ETFs and structured products. I'm not saying that you should not have unit trust investments or you should not have direct listed share portfolios. As a matter of fact, over time, you should have a combination of these four products. So let's have a look at what the benefit is of investing in an index as opposed to directly in shares. So this is the JSE Top 40 as at 1990, with all the companies that made up the top 40. If you fast forward the clock 19 years, these are the companies that still exist today. And if you have a look at which companies are still on the list today, in other words 29 years later, only 3 companies are still in the top 40 today. So what I want to explain here is that the benefit of investing in an index is the index washes itself. So you don't have to worry if you own an index, which shares will be the top shares in the next 3 to 5 to 10 years, because you own the index. You automatically own the top 40 in this example, but we will see when we go into Britannic, it's the top 500 companies in America, the top 225 companies in Japan, and the top 50 companies in Europe. So the index will wash itself. As soon as a big company falls out, a new one comes in. Let's have a look at how did the share perform over the past 5 years. I basically covered that when I made my opening statement. It yielded 38% as opposed to the market, which only gave 7.69. So yeah, that's about 5 times what the market returned. just go back there. Okay. Whenever you look at any investment, you have to consider these 4 factors, and that is how much does the investment cost, how much risk am I taking, how much capital am I putting at risk, what is the potential upside or the potential return, and what are the tax implications. So in order to compare apples with apples, you have to look at the risk-adjusted returns net of all taxes and net of all fees. So I'm going to use these 4 factors to unpack Britannic. So let's first look at fees. So Britannic, all the fees have been built into the par value of the share, but from a disclosure point of view, the total fees equate to 1.33% per annum. This is your annual effective charge. This includes the advisor fee. There is no administration fee. It includes in Investec's fee as the investment advisor. I myself being a distributor, all fees, total fees of 1.33% per annum. I do not charge any upfront fees. You'll see in the Investec material they make reference to a distributor may charge an upfront fee of 2%. That won't be applicable, as I do not charge any upfront fees. So from a fee perspective, the fees are very, very low. I'm not sure if you're familiar with what your annual effective charge is on your investments, but do yourself a favor and ascertain exactly how much are you paying. If we just have a look at Alan Gray's Orbis's Global Equity Fund as an example, just the fund fee is 1.88% per annum. That's excluding any administration or platform charges and excluding any advisor charges. Well, let's have a look at Investec Global Franchise Fund as well, also sitting at 1.88%. So in order to compare apples with apples, you have to work out what the total EAC, effective annual charge, is to compare it with Britannic, and you will find that 1.33% is very low because that includes 100% or 103% downside protection or capital protection. So how does the fees work? So they basically build it into the par value of the share. So in 2014, the par value per share was £1,000. Of that, they put £747 on a structured deposit with Investec, which accrued interest at just over 6% per annum over the 5-year term to mature back at £1,000. And that's how they guaranteed you your capital. So on day one, they basically had £172 per share to buy an equity option with, and there was provision made for fees of £80 per share, which equates to the 1.33% per annum, which I've just explained. If we have a look at the risk of the investment, Britannic Opportunities Ltd gives you equity returns, but without taking equity risk, as the risk of this investment will be what we refer to as sub-debt bonds, subordinated debt, which is far less risky than equity risk per se. So here's the same asset classes that I showed you on the other slide: cash, bonds, property, equity, just showing you from a risk point of view which asset class, how much risk do you take when investing in such an asset class. If we unpack the subordinated debt, which will be the credit risk that one will be taking on First Rand and on ABSA, this graph basically illustrates, who takes the least risk to who takes the most risk, and from an application of loss perspective, who stands to lose all their money first, then second, then third, fourth, fifth, and then sixth. So how does this work? If we own the sub debt, we take credit risk on FirstRand and on ABSA, which basically means that the ordinary shareholders of FirstRand and ABSA must write down their total share capital down to 0 before the preference shareholders would have to take a haircut. They would have to write the total value of the preference shares down to 0 before the subordinate debt holders would have to take a haircut. So let's just have a look at FirstRand and at ABSA. FirstRand's market cap is currently sitting at 346 billion rand and ABSA is sitting at 134 billion rand. So a combined market cap of 480 billion rand. So for you to stand a chance of losing any money over the next 3.8 years, both FirstRand and ABSA's total ordinary share capital has to be written down to 0 before you stand a risk of losing any money. So from a risk point of view, low risk investment, not a high risk investment when compared to owning just naked equity. How do you manage risk? You have to diversify. Just to explain diversification, if you have 100 Rand to invest and you invest in 10 shares and one of those shares goes bust, you basically lose 10% of your capital. But if you take that 100 Rand and you invest in 100 shares and one of the shares go bust, you basically lose 1% of your capital. So when it comes to spreading the risk, you have to invest globally. You can't just invest in South Africa, which is less than 1% of the world economy. So if we have a look at the top 2,000 companies in the world, this graph illustrates where those companies are listed, and you can see that the majority of the companies are listed in the United States. Then you have China, Japan, and Europe with between 50 and 99 companies, and you can see South Africa only 10 to 19 companies that are listed in South Africa of the global 2,000 companies. So this investment gives you access to 40% allocation to the top 500 companies listed in America, a 30% allocation to the top 50 companies listed in Europe, and a 30% allocation to the top 225 companies listed in Japan. Let's just take a look at what happened historically in order to appreciate a minimum 3% positive return at expiry. So Britannic guarantees you your capital plus a minimum 3% positive return. So if we have a look at the S&P 500, the Nikkei 225 and the Euro Stoxx 50 over the last 30, 17 and 32 years, you will see that over a 3.8 year period, the maximum loss that has occurred was minus 35, minus 44 and minus 48%. So you would agree with me that if you were invested in the S&P 500 during this term and you received a minus 35% return versus an investment product that guarantees you a minimum 3% positive return, that you would have been 38% better off had you owned something similar to Britannic that can guarantee you not only your capital, 100% of your capital, but also a minimum 3%. So if we look at that in a little bit more detail, as you know, if you lose 40% from 100, you need to gain 67% just to get back to 100. How do I get that? So 100 minus 40 gives you 60. So to make up 40 over 60 is 67% in order just to break even, to make up the loss that you've incurred. So one can actually, if we have a look at those same figures for the S&P 500, the Nikkei 225 and the Euro Stoxx 50, with the respective losses that has been incurred over a 3.8 year period, this is the growth required subsequent to the loss in order to break even. So you can see something like the Nikkei 225 at a minus 44, you almost need to grow by 80% in the following years just to get back where you were. And if you have a look at the Eurostoxx 50, a minus 48 equates to a 92% growth that is required just to break even. So definitely a lot of value in having 100% of your capital guaranteed, and this does not even take into account the positive minimum guaranteed 3% return. If we now have a look at the returns, what are the returns that are linked to the investment? We have basically gone through this graph already, but equities is the best asset class that you can invest in from a return perspective. If we have a look at the MSCI World, and yeah, let me just quickly find that. Okay, the 40% allocation to the S&P 500 and the 30% allocations to respectively the Eurostoxx 50 and the Nikkei 225 equates to a 97% correlation to the MSCI World Index. So the MSCI World Index is linked to 23 developed markets with 1,636 shares. Britannic will only own 775 shares, but with a 97% correlation to the MSCI World. So I've highlighted some positive and negative figures here for you just to show that shares do not go up in a straight line. As you can see, there's a lot of volatility along the way. That is the MSCI Emerging Markets graph. So we should have a look at the blue line, which is the MSCI World. And as you can see, last year it took a -8, the year before that positive 23, and so on and so on. And in 2008 it experienced a huge drawback of -40%. But what I want to get to is, if one have a look at the long-term average return over the last 32, or let's call it 31.5 years, you will note that the index has yielded just close to 8% per annum. So if we have a look at the last 10 years annualized returns, you will note that it's sitting at 12.2%. So equities always revert, the yields reverts back to the mean, and if the mean is 8 and the most recent historic annualized returns are sitting at 12.2, it means that we can expect muted returns over the next couple of years, as the last 10 years has certainly been, a very good 10 years compared to the last 31.5 years. If you have a look at the companies that's in the index, it's all companies that you're familiar with. These are the top 10 shares in the index: Microsoft, Apple, Amazon, Facebook, JP Morgan, Johnson & Johnson, Alphabet, Exxon, and Nestle. And that makes up about 12% of the total index. So if we now have a look at that same MSCI World Index, which Investec has put on a graph here for us, you can see that from 1988 to now, there was obviously some good times, a bit of a recession with a market pullback. Session ended, market delivered quite strong returns, and the most recent crash that we're all very familiar with was the 2008 global financial crisis, and you can see what happened to the share price. That lasted about 18 months, and then this last 10-year bull run basically started. So this is where we're at now, and what this graph illustrates is that in 3.8 years from now, there can only be one or two outcomes, and that is, if the markets end below the current levels, you will minimum get your 103% return, so that's your 100% capital plus a 3% positive return, or you will get a maximum of 34%. And we're going to go into a little bit more detail as to how does that work later on. But so what Investec is basically saying here is that over the next 3.8 years, there's no reason for concern if markets, pulls back a little bit, as you are guaranteed to receive one of these two investment outcomes. When we have a look at the historic performance of the share on this graph, what this next graph tries to illustrate is that if the market falls, you will basically have the opportunity to sell out at any time and go and buy the live market. But I'll go into that on another slide. With this slide, I just want to show you that the clients that own the structured product, which is basically the black line, this would have been their outcome after the global financial crisis. They got 100% of their capital back in pounds. And clients that owned the market, and in this case this was called the Euro Asia, which had a 50% allocation to the Nikkei 225 and a 50% allocation to the Euro Stoxx 50, they at one stage were down minus 55, but the market subsequently recovered a bit, and including dividends they were down minus 38%. So unlike any other structured products, with Britannic Opportunities you have daily liquidity. This is an extract from the Investec material, which basically says that if you want to sell at any point in time, we can do it on the principle of willing buyer, willing seller. What they mean by that is that they will play market maker. So if you want to sell, they will ascertain if there are any buyers that would like to buy the share from you. If not, they will use their capacity to buy the share from you at a brokerage of 1.25%. They have a capacity up to about 60 million to buy back from you, and if the amount that you wish to sell is greater than 60 million, they can unwind the bond and unwind the option, and basically within a 10 business day period return your money to you. So what is the advantage of having daily liquidity? First, let's just have a look at how does the market value of the share price gets calculated. And it comes down to, it is the value of the bond plus the value of the equity option, which basically determines the market value of the share. So if we add those two together, we get $1,368.99 pounds, less the £1,000 that the client paid for per share upfront, gives you a profit of 368. 368 divided by 1,000 is 36.9%. So this is the current status quo for current shareholders. As at the 7th of June, they can sell out at 36.9% profit should they wish to sell. What I've done here is just to have a closer look at the historic fund fact sheets of Britannic Opportunities Ltd, just to show you what happened to the bond and what happened to the equity option price using different month-end periods. So at inception, like I showed you here, 747, 172, 75, and 4.92 was the cash that they had in the bank account of Britannic Opportunities Ltd that was utilized to pay the advisor and the distributor. So that's the figures that I've quoted down there. And then I've took some random fund fact sheets, 30th of April 2015, 30th of September, basically every 6 to 8 months. And one thing that you must note here is that the bond always steadily increases regardless of what happens to the share market. Why is this? Because the bond is going to mature back at exactly what the par value is that the clients put in. So Investec calculates upfront of the R1,000 that you pay per share, how much do they need to put on the deposit so that it matures back at exactly whatever you've put in. So Britannic Phase 1 only guaranteed 100% of capital, so that is why the cost was 1,000 and the deposit was going to mature back at 1,000. But you can see here it steadily increases over time. The equity option, however, is a binary option. So what that means is that it will either have a positive value or a negative or zero value. So if the equity option is in the money, it will have value, and that value will be added to the bond value. And if the markets were negative, this value would have been zero and the client would have just gotten his money back. But you can see here the equity option went down from 172 to 169, then it fell to 97, it went up to 102, but now that we're closer to maturity, and with the probability being that over the next month, the FTSE is going to end on a positive 0.01%, you can see that the equity option is pricing very close to the maximum value of 380. So on the 7th of July next month, this will be the value. The bond would have accrued from 747 to 1,000. The equity option that we've paid £172 for is going to be worth £380, and all the cash that was in the bank account that for fees that had to be paid out has been depleted. That's now sitting on zero. So the par value of the share is going to have has increased from £1,000 to £1,380 per share. So let's come back to this slide now to show you what's the value of having daily liquidity. And like I mentioned, this is the Euro Asia. It's the share that took the most stress during the financial crisis. And the maximum that this share was down at any point in time was minus 10%, compared to the live index was down minus 55. So if we just have a look at some figures here, so you could have sold out of this share, which is the black line, at any time, and let's assume you sold out there. You could have taken a loss of minus 10, and you could have gone and bought the market back at minus 55. So that is a huge advantage, as no other investment that you own can give you the upside linked to equities and give you the option to get out if there is a crash at much less than what the market will fall by, to enable you to go and buy the live market. So you can utilize your daily liquidity to sell at any time and go and buy the market directly. And this is a huge benefit to have. So if we have a look at Britannic Phase 2 now, and let's assume the MSCI crashes by 40% as it did in 2008, halfway through the investment term. In other words, in May 2021. So what will Britannic share price be? So obviously the existing shareholders is in a pound asset class, which is the Class A shares, and new shareholders coming in is going to subscribe to the Class B shares, which will be US dollar shares. So just want to use this to basically explain what you can expect from a share price perspective. So let's assume you put in $100 per share. 82% of that is going to be put on a deposit, which will yield or accrue interest and mature on 103. So you will note you're going to put in 100, but you will get 103 back, as there's a minimum 3% positive to return that's guaranteed. So basically from 82 to 103, it's 21 dollars worth of interest that has to accrue to get you from 82 to 103. So if we divide the 21 by 2, seeing that May 21 will be halfway through the investment term, we get 10.5. So if we add the 10.5 to 92, up to 82, we get 92.5. So the bond by May 2021 will have accrued interest from 82 to 92.5. The option, we've basically used a value of a half. So that is a loss of 96% on the value of the option, from 12.5 to a half. And this is just a hypothetical worst case scenario that figure that we've used. Fees obviously will sit in cash in the bank in Britannic and be paid to distributors and advisors on an annual basis. So there should be about half the cash still in the bank in Britannic halfway through the investment term. So if you add this together, you get to 95.5. So in other words, 4.5% loss if the market is down 40. But there will be an early exit penalty if there's no willing buyer at that point in time, and Investec has to basically buy the share from you. So let's subtract another 1.25. So that will leave you with a share value of 94.25. So 100 less than 94.25, that means that you would be at a loss of about 5.75%, which you can realize and go and buy the market at a minus 40. So once again, huge benefit of this product is the fact that you have that liquidity and that you're not locked in for the full 3.8 years, and that you can get out at much less than what the equity markets will fall by. So this creates a good buying opportunity. For those of you that are mathematically inclined, just want to double check how did I get to those figures. So just ignore the rands there. If you put $82 down and you want it to grow to $103 over 3 years and 9 months, it basically has to accrue at a compound interest rate of 6.259% per annum. And you will see in the annexures that this corresponds with what the actual yield on the First Rand and ABSA bonds are. But we'll get into that detail a little bit later. So if we have a look at the investment payoff profile for the 3.8 years, this is basically the blue line is what the market delivers. So if the market yields a negative return, and regardless whether it's minus 5, 10 or minus 30, you will be guaranteed a 3% return, the red line there. And then you'll see from 103 to about 118.5, you will receive 200% of whatever the market is going to do. So if we just have a look at that, for you to get 34% return in dollars, the market only has to yield 18.5. How do they get that? It's the 18.5 less the 3 is 15.5. times 2, because you have 200% participation, that gives you 31, plus the guaranteed 3 gives you the 34. So from a probability perspective, I don't know about you, but if we have a look at that other graph that I've shown you from where markets are currently at, from these levels, what are the probability that it's going to deliver more than 8% per annum, going to continue on the 12% per annum? Remember, the green line represents 8% per annum, versus maybe a more muted return, a little bit sideways, or a 3 or a 4% return. From where I'm sitting, my personal view is that the probability is a lot higher that the market is going to do 18.5% over the next 3.8 years, versus it's going to do more than 34%. And if I can get an 8% real return without having any of the downside risk, I think it's a fairly decent compensation, seeing that the MSCI World over the last 31.5 years has only yielded 7.93%, and that was without any downside protection whatsoever. When we have a look at this investment, the last factor that we have to consider is the tax. What are the tax implications? If you keep the shares at maturity, no tax event will be triggered, and you can lock in the growth without triggering a tax event. There's no other asset that you own that you will be able to do that. If you take any listed share that you own, or any unit trust, if you want to unlock the value, you have to sell. Whenever you sell, you trigger a tax event. But because here you are a shareholder in the Guernsey company, and the Guernsey company owns the bond that accrues interest, and the Guernsey company owns the call option, which can attract capital gains tax, no tax is payable in Guernsey because they do not have any tax. So you keep your shares in the Guernsey company, and the Guernsey company makes the profit, and there's zero tax on the profit. So that is how you are able to lock in capital growth without triggering tax events. But if you do want to sell at maturity, it will be capital gains tax that will apply. So it will be your hard currency growth in dollars converted back to rands, either at the average rate of the last 1 year or the spot rate at that point in time, on which you will pay capital gains tax. And just keep in mind that you will obviously be able to utilize your 40,000 capital gains tax exclusion as an individual. Of course, if you sell before the end of the investment term, there is a chance that it might be subject to income tax, especially if it's sold within year 1 to 3. So ideally, you only want to invest your 7-year plus money in this structure. You do not want to invest any monies that you anticipate you're going to need in the next 3.8 years. So how do you invest in Britannic Opportunities Limited? If you have rands currently, you would have to convert it to dollars. You can do that by using your single discretionary allowance of up to 1 million rand per annum. Which is included in, for what you use to travel. No tax clearance is required to convert your rands to dollars. You simply have to complete a one-pager at your bank, and they'll be able to convert your rands to dollars and send it over. If you want to invest more than 1 million, you would have to do it by way of your foreign investment allowance, which is up to 10 million rand per registered taxpayer. But for that, you do need a tax clearance from SARS in order to utilize this option. And you also have to provide SARS with proof that you have funds that you can invest offshore. Or the other way would be is if you already have money overseas, you can cash in any of your existing investments and basically just transfer it over, and this will obviously not form part of any one of the aforementioned allowances. Or the third option would be if your taxes are not up to date and you want to invest more than 1 million, you can do it by way of an asset swap. An asset swap costs between 0.3 and 0.5% per annum depending on the investment amount. And maybe just the last options to mention is from a company or a trust perspective, you can't invest directly offshore in any event. The only way you can invest is by way of an asset swap. So that would be basically the same as this option here. So if you have money sitting in a company or a trust that you would like to invest, you can do so by way of an asset swap. Here with my contact details, if you want to get a hold of me, you can reach me at Johann with a double N .Strauss with a double S at psg.co.za, or you're welcome to phone me on my cell phone if you would like more information on Britannic Opportunities. And yeah, that's it. Please do not hesitate to contact me should you have any questions or queries. Thank you. Cheers. Bye.